And let's bring in Dan Suzuki, the Deputy Chief Investment Officer at Richard Bernstein Advisors. Dan, great to have you with us.
Thanks for having me.
You and your firm have been sort of cautious of these markets for some time now, and I'm wondering, how painful is this to have, big cap tech like we saw today just keep flying when your emphasis right now is on sort of the value areas of the market?
Well, what's interesting, Melissa, is that we were cautious going into this year, and that positioning served our portfolio as well. But actually, since April, what we've been doing is gradually adding back cyclicality. So we have been participating in the recovery in the markets and the economy at large. But we have been, to your point, doing it with the absence of the big tech names. We think that we're not the type of company that's going to chase crowded, expensive names, and so I think that those names are getting more crowded and more expensive. And when I look forward on the potential way that this recovery could go, one of two things is probably going to happen, right? You don't have to be a genius to think that either you'll get more stimulus and that this recovery will continue, in which case you want to own cyclicals, right? And tech, what we found was so resilient due to the nature of this pandemic is that they just have less operating leverage to recovery than some of these beaten down areas. On the flip side, if things do get worse and we morph into more of a traditional recession, I think that that's where tech cyclicality, which we haven't seen at all this year, may come through and surprise investors. Because think about we've seen Salesforce up today, but think about all these tech companies. What happens if we move into a more traditional recession and you see households and businesses have to slash their budgets? So I think that from here, in some ways, you could argue that they're damned if you do, damned if you don't.
Dan, currencies are typically things, we don't talk about all that much, but it's a front center right now. Is there a point where the weaker U.S. dollar ceases to be a tailwind for equities and actually starts to become sort of a headwind for them?
Yeah, I think, thanks for the question, Guy. Yeah, I think that there is a point, but I think we're pretty far from that point. Typically, we like to look at sort of the year-on-year numbers, and when you look at those year-on-year numbers, it's typically not till you see sort of a negative 5 to 10% level where it really starts to be a noticeable negative for equity markets. I don't think we're there yet, but it's something we're monitoring to see if that's the trajectory going to go, and some of that's going to be dependent on Fed policy.
Dan, we were just having this discussion before about the markets and the political process. With the stock markets at record highs, do you think that this is the markets telegraphing the belief that there could be a Trump victory in the cards? Or do you think it's just simply too early to extrapolate that?
Yeah, I think that the market on some level is starting to factor in the election. I think it's less an implication for sort of what you're seeing on a day-to-day in the markets. But if you look, I mean, there's been a clear correlation between the economy getting better, COVID cases going down, Trump's improving in the polls and the betting markets, and the markets hitting all-time highs. So it's hard to parse those all apart. I think that when you look at the volatility markets, though, you've seen, over the past few months that you are starting to see increased concerns around volatility as we reach the election. And I think that is more of the direct sort of market reflection of what's happening with the election polls.
Got it. Dan, thank you. Dan Suzuki, Deputy Chief Investment Strategist over at Richard Bernstein Advisors.